Hello listeners and welcome to the show. This is Sam Abrika, the CEO of Nova Money, an AI financial planner designed to help you build financial freedom. In this episode, we will learn how to invest in real estate starting from scratch. We will hear the story of Lane, a former civil engineer who, after years of hard work, eventually managed to build enough passive income to quit his job. If you ever search real estate investing on the internet, you will find a lot of fake gurus talking in a strange language full of jargon. This is because they're sadly targeting vulnerable people who don't have enough financial education to see it's a scam. And as Lane will explain, investing in real estate is simple but not easy. Hello Lane, very excited to have you today in the show as a guest. Today's topic is all about real estate investing. So, welcome, Lane.
Yeah, thanks for having me. Appreciate it.
First question, why did you choose to go for real estate investing?
Well, I kind of started on this linear path where I was kind of taught to be really frugal with my money, max out my 401k, my retirement accounts, and became an engineer and just started to build wealth, save my money, and eventually buy a house to live in, which I don't necessarily think is a good financial decision. But I turned it into a rental, and that was where I got this taste of passive cash flow from renting my property out. And I realized that if I just rinse, wash, repeat, did this again and again and again, I'd be able to quit my day job by replacing my salary with this method. Why real estate? It can be done passively, and tax benefits, the fact that the tenants are paying down your mortgage for you, it's amazing. And we have great leverage options. We get great debt on this type of stuff. So, and it's a hard asset at the end. So that's why real estate. Eventually quit my day job. Currently own 4,800 rental properties today, and it's worked. And I've kind of done this, been able to quit my day job in less than a decade doing this stuff.
Well done. A lot of people who try real estate investing start exactly the way you did. They buy their first property to live in. This is their house. And they often don't see it as an investment, but rather as an emotionally driven decision to live with their house, to build with their wife or their partner, to build a family. And it sounds like this is how you started. What was the trigger for you to say, now I'm going to rent my place, I'm going to leverage, and I'm going to multiply this strategy?
Yeah, the first one was just all by accident. I was, as a new young engineer, they usually send the new folks out on the road. So I was really never home at all. So I was only home on Saturdays. So for a young 20-year-old guy, that seemed pretty wasteful for me. So I was like, well, let me rent this thing out, right? So that's where I got the taste of cash flow. And then that's where I really got a little more sophisticated, started reading the books, the podcasts. Have my own podcast today where I talk about real estate investing, buying own rentals. And this is where I really started to learn, about cash flow investing, and just started to pick up more and more rentals. Initially, it was slow because I was limited to how much money I had from saving from my day job. Because the way I do it is, we just do boring Fannie Mae, Freddie Mac government subsidized loans where you need 20% down payment. Maybe I should have started this at the top, but the type of investing I do is passive real estate investing. You need money to invest. All these no money down, wholesaling houses, flipping houses, I don't do any of that type of stuff, right? To me, that's a job. But if you have a good paying salary, you're able to save your money, eventually you want to move into the passive investing side, which is just, you need money to do that.
Right. You need to save for the initial deposit or the down payment, as it's called in America. And once you do that, most people, they buy the flat for themselves. And often the game stops here because they will spend their entire life repaying their own mortgage, and they will never buy another property, and the third one, and the fourth one.
Exactly. And we're all kind of brainwashed to have that be the path, right?
Yeah, get a stable job, get a stable house, build a family, and that's it.
Work for 40, 50 years. Maybe you might get to retirement, right? That's the song and dance.
Hope that your pension fund, hope for your pension fund to do well, and maybe you will retire at 65.
Right. But if you're a millennial and you're thinking you're going to get a pension, you probably believe in Santa Claus and the Easter Bunny and all these fictional characters. It ain't gonna happen, guys. Here in America, we have Social Security. That stuff isn't gonna be around for folks. That's a joke. And retirement accounts, all these supposedly like tax-free things, like none of the wealthy do this stuff, is what I've kind of realized. They invest in businesses or real estate, and they invest on their own accord. The problem with all these, like here in America, we have 401ks, but we're stuck in this. When you're in the 401k, you're stuck with this garbage options. And those garbage options are just what the big brokerages want you to invest in because it's heavily feed to death. And they take a lot of the profits away from you. That's ultimately why hardworking folks struggle to get ahead because they're stuck in quicksand with this stuff. So I kind of realized this early, like when I had my first rental property. It wasn't that great of a rental property. The numbers weren't that great, but I was able to make 20 to 30% returns of my money. When you include the appreciation, tax benefits, the fact that the tenants are paying down your mortgage for you, where when you own your own house, you're the one putting in a heart, sweat, and tears to pay down the mortgage. And then lastly, you're making money with the monthly cash flow. We'll talk about that later, the 1% rent to value ratio. But
right. What's exactly the 20 to 30% profit? Is it like the return on capital that you have invested, or is it when you sold your first property?
Right, the return on capital on a month-to-month basis.
Wow, that's super high.
Right, and I was like, well, why would I want to put my money in the stock market thing at 8 to 10% where it goes up and down like a roller coaster, when I can just kind of do it on my own, make double, triple this? If people don't believe me on the numbers, they can go to my website, simplepassivecashflow.com/returns. I do a little whiteboard exercise with the numbers if you don't believe me. But this is where I started to realize, like, this whole system is engineered against us to kind of take our money away, keep us working forever. Whether you call it corporate greed or, these brokerage, that's how they make all these big buildings and high Wall Street salaries and stuff like that. So what I'm advocating for people to do is just spend a little time to learn this yourself, do it on your own, and get all the returns that that's you deservedly should get, and don't give most of it to the big companies.
I've worked a bit in the investment fund industry. I was looking at all their return in their shareholders' report. Most of them didn't have 20 to 30% return. They were averaging around 3, 4, 5, maximum 10%. What's your secret?
Even worse, right? 3, 4, 5%.
I'm not talking about the negative ones.
Yeah. What's the secret? There is no secret. It's just cutting out all the middlemen and the people putting their fees on top of the investment. When you do it yourself with a rental property, or you go into a smaller deal with some other investors, you reap all the rewards. It's just essentially like buying something wholesale instead of going to the fancy department store to buy the same product.
Okay, let's get into it. What's your strategy to buy the flats?
Yeah, so a lot of this is predicated on cash flow. So this is a little counterintuitive, but we don't buy in places that are high price, primary markets such as here in America, Los Angeles, Seattle, New York, Boston, Hawaii. These areas, you're not going to find what's called the rent to value ratio that you need to cash flow. The quick and dirty rule that we use is we're looking for a rent to value ratio of 1% or higher. So you find the rent to value ratio by taking the monthly purchase price divided by the monthly rents divided by the purchase price. So for example, kind of the prototypical rental property we'll find is something that rents for $1,000 a month. That's $100,000 purchase price. So 1,000 divided 100 grand is 1%. You guys can do the math on your own on what you see around you, and if it's under 1%, you won't buy it because it won't cash flow on a monthly basis, right? Not saying that properties in California, Seattle, New York won't appreciate, but we are better. We don't bet on appreciation. I consider that gambling. We go more off of the monthly cash flow, which we feel is more prudent, whether in a good or
so you're
bad
looking
economy.
for immediate value on the rent to cost ratio of like how much you were going to pay on your mortgage and how much you're going to extract as inflow on the rent. You don't
Right.
bet that the economy, there will be like inflation and appreciation of the real estate. You don't care about all of that.
That's all icing on top of the cake, right?
Got it.
But the thing that I'm looking at as the primary indicator going in is, am I going to cash flow on a monthly basis? Are the rents going to pay for the principal, interest, taxes, insurance, or the mortgage, plus repairs, plus vacancy, plus paying a professional property manager to do my dirty work for me, plus a capex budget so that the roof's going to go out every 10 to 20 years, appliances are going to go out every 10 years, things like that needs to be accounted for.
Plus taxes.
Right, right. Everything that this thing is going to cost you, right? Because rental properties are not maintenance free or cost free. So you need to account for it and pay for it out of the monthly revenue that you get. Just like any business.
And do you try to be positive cash flow on a monthly basis?
Yes. If not, we don't buy it.
Got it. So every deal that you make brings you money from day one.
That is correct. I mean, there are some geographic areas, such as like Austin, Texas, for one, great market, but it just doesn't cash flow. So I don't invest there.
How do you do to find those deals? Because most of the time, when you look at the rent to value ratio, it's not that great. And there's kind of like an equilibrium. The same flat, if you have to rent it, it's much cheaper usually than if you have to buy it and pay mortgages. Unless if you take very long duration mortgages like 30 up to 40 years, or if you have a very high down payment.
Well, the down payments are pretty much fixed, right? You're looking at a 20% down payment. Typically, you can't get anything less than that. And we try and maximize the amount of leverage that we can get. But
okay, so it's still capital intensive, right? Every property will cost you the 20% down payment. You will get finance only for 80% of the value of the property.
Right. When I was buying my rentals, bought the one the first year, then I had to wait a couple of years to save up for the next one. I mean, it took me 7 years to get up to 11 rental properties. I mean, it's watching grass grow. I mean, this is not a get rich quick scheme at all, but it is a get rich surely thing as cash flow builds on top of each other. And now you can acquire properties quicker and quicker and quicker.
And what kind of property do you buy that gives you positive cash flow right away?
Yeah, so
is it new? Is it old? Refurbished?
Typically, you're not on the high end. You're not in luxury properties, and you're not on the low end. War zone areas where your collections are going to suffer, and it's really dangerous war zone type of areas. But there's a sweet spot in the middle. Here in America, you could probably define that as $700 to $1,200 a month rent. That is, your lower middle class workforce housing type of clientele, which is huge here in America. And I think a lot of places around the world, the middle class is shrinking. The lower middle class is this huge glut of the population, which needs good value housing, which we provide. And then, like a lot of the people are probably struggling to find these types of 1% rent to value ratio properties. You're probably going to have to look elsewhere geographically. I live here in Hawaii. Well, I'll never find a place that'll cash flow here in Hawaii. But I invest in places like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock, Huntsville, Alabama, places like that, which you may, or if you're not from America, you've probably never heard of these places, right? But this is how the most of the country lives, not in the sexy markets, not in the gateway markets. So you have to look elsewhere, and it typically will not be in your backyard.
You obviously have researched a lot the market, you understand it. You have spotted that there was a sweet spot which was probably underpriced. Why do you think there is such a market anomaly in the middle ground, like not in the luxury, not in the very, very low grade housing? Why is it so profitable there?
Well, it's kind of the sweet spot. I mean, on paper, it's more profitable on the low end, but I'll tell you, with all the headaches and issues that will happen, you're not going to make money at the end of the day. So there's a sweet spot. We grade properties from A, B, C, D class. A class are your properties that are 30 years, 40 years, and younger. Your Class P properties might be built in the 1980s, 1970s. Your Class C properties are built in the 1960s and 50s. So we kind of target those 1960s to 1990s properties. It's kind of that middle area where we can cash flow and have the least amount of headaches and tenant profile. And part of that is we want a strategy that does well in a recession, bad economic times. And the idea is in bad economic times, the people that are living in the luxury apartments or houses, they lose their jobs and they have to move back to more of a value-based Class B housing, and which is where we like to be. Right? We want to catch people as they fall to us. And we also want to serve the glut of the population today. So this is why, it's kind of like a boring strategy, but it does really well in a recession, and we've seen it kind of play out through the pandemic.
It all makes sense, actually. You're just saying staying away from the shiny property, luxury, and from the bad deals that will just won't give you the return.
Right.
How do you find the good deals? Because America is a huge country, and I have friends, they are doing real estate investing, and they usually take like 1 year to study in depth a city, a market, to really understand what's the best value to buy, at which price to buy, what's the most interesting kind of flat to rent. And it's just for one city, like one large city such as Paris or London. How long did it take you to develop such an expertise for America?
For us, it's like we're buying commodities, right? Things that cash flow. We hire property managers and inspectors to make sure we're buying a good property in a good area. But as far as we're concerned, it's not something that needs to be like spotted out through a fine-tooth comb. The numbers work, we proceed ahead, and we kind of do due diligence, of course. But for people, like, where do you find deals? Where you hire professionals, brokers, property managers help you source these deals. If you're brand new at this, the way I started was I bought these things called Turnkey Rentals. So what those are is like a house flipper will pick up a beat up property, fix it up brand new electrical, plumbing, flooring, appliances. Sometimes they'll even put a tenant in there for you. So it's truly like, rental property with training wheels. People want to learn more about, this strategy. I have a guide on my website, simplepassivecashflow.com/turnkey. Great way to get started. That's how I got started. But yeah, a lot of it is getting good deal flow. As I kind of, built up my portfolio, I started to go into more of these larger deals because I wanted to get away from your mom and pop investors buying, 1 unit, 2 units, 8 units, 20 units. I wanted to get into a 60, 100 to 300 unit properties to get away from that competition. And competition is a big thing, because competition is what is the dumb money that bids up properties. So just like how, you don't want to buy properties in Los Angeles or Paris, right? Because you just have so much stupid money there that is unsophisticated, pushing prices up. This is why you go to less hot markets, less like known, more of the flyover areas in, out there, maybe in rural areas of the country. And you buy these properties that aren't the luxury high-end stuff, because most unsophisticated investors are scared from that stuff. They want the shiny objects. So this is kind of why we kind of stay in this like working class kind of sector.
Got it. You started buying your first property as just a regular engineer. So you had a job, you were employed, you waited, you were patient to get your 20% save down payment. Can you tell us, how did you get your first mortgage? How did you negotiate that? And then what was the change when you wanted to buy your second property?
Yeah, that's actually the easy part. You just go to any bank and they'll give you a loan, right?
So no secret, no special trick, just save it.
I guess the one secret is like you want to work off referrals, right? Because not all lenders are created equal. At the end of the day, they're all looking at the same computer screen and giving you the pricing on the government sponsored type of stuff, the government backed loans, and they're going to apply, a certain percent, maybe 1% or 1.25% or 2% fees, so they can stay in business for kind of doing their service. But essentially, it's the same damn thing, just sold by a different person. But when you're going through underwriting, you're getting approved, making sure you're working with somebody who has done this in the past and work with investors, or most people, they just work with homeowners, right? So there's a big difference. So, this is kind of gets into like your network is your net worth. If you have other investors in your corner and you want to work off referrals, the best way of going. But essentially, you could walk on over to the nearest bank and get a loan from them. Wouldn't necessarily like recommend that. I would always say go off referrals, off of more of a specialist that works with investors. But I mean, as long as you have the 20% down payment, adequate credit score, you're not in huge like debt, you have good income, which kind of equates to debt service coverage ratio of at least 50%, you should be good to go.
Okay.
I
And
mean,
then
after
when
all,
do you
from a
get?
lender's perspective, it's a hard asset. It's real estate. It's good,
Yeah, I mean the mortgage market is quite efficient. Banks lend a lot of money to for people to buy mortgages and houses.
right?
And then, how long do you wait to get your second house? Because most people need to wait a lot to get 20% down payment saved
Yeah, and this is, that's the hardest thing, I think, is saving your money.
to get
Like
started.
tightening the belt. I work with a lot of high net worth clients, a lot of doctors, engineers, lawyers, accountants, but more importantly, I work with a lot of like really frugal people that are able to save a lot of money. Most of my clients are able to save at least $30,000, $50,000 a year. So, they can be buying a property or two a year. And,
I think
the more
that's
they,
the important part because there are lots of people who earn a lot of money and they're broke. They save absolutely nothing.
right, right. But then, in their defense, right, if, what are their options? Well, crappy, like Wall Street type of products. I mean, I wouldn't be too motivated. I got really motivated when I started to equate, hey, if I save up $30,000 for a down payment on a house, that means I get $300 every month just in cash flow coming back. That can like equates to $4,000 a year to buy that next property even quicker. That was very motivating once I got to that point.
So that's it. You just wait to save for your second property because now you have extra cash flow from your first property.
Right, that's simple passive cash flow. Rinse, wash,
No
repeat.
trick, no magic.
No, tricks are for kids,
Damn
man.
simple.
I mean, like, I think that's where like a lot of real estate educators and gurus got this all wrong, right? They're trying to work with guys who are broke. I don't work with broke guys. When you're broke, you got to try all these like tricks and games and things that don't really work and smoke and mirrors. But with real estate investing, you need money to invest. If you don't have money, you can't invest, man. You got to go. I mean, there's a lot of tactics for no money down. I just don't do any of that type of stuff. I don't teach it. I work with people who are responsible with their money and want to prudently invest in hard assets such as real estate.
If it's so simple, why so few people do it?
Yeah, I mean, if everybody said what I'm kind of preaching is, buy a handful of rentals or go into syndications or private placements as a private LP investor, people would be able to quit their day jobs most in like less than a decade. How would society function, right? Who would build our bridges? Who would get our coffee? Who would do anything, right? If everybody was financially independent.
America already lost one engineer.
Yeah. I mean, I'm not going to say I was a very good one. I was kind of a lazy engineer with that. But I mean, look, there are barriers to this, right? And buying, people are probably listening and like, oh, I don't understand the numbers. It's like, dude, like, well, first of all, download my analyzer on my website. It's for free. simplepassivecashflow.com/analyzers. Learn the numbers. It's not freaking rocket science, guys. This is not complicated stuff. This is like high school math level. Understand how the numbers work. And then some people might get hung up on, oh, you're telling me I have to buy something where I can't feel it, touch it? You got it, bro, right? That's what you want to do if you want to go into a cash flow positive property. And at that point, you've thinned the herd. 90% of people won't do anything. Financial independence is not for everybody. It's for the worthy that are willing to put themselves out there, get out of their comfort zone, execute, and take action. And that's why it's so much sweeter for people who get there.
So it sounds so easy then to get your first house. Well, easy. let's say, simple but not easy.
Right. Simple but not
You wait.
easy.
You wait to have saved 20% down payment. You buy your first house. That first house is giving you positive cash flow every month. You reuse that and you keep saving to buy your second house, and then you keep going. How does the mortgage negotiation go with the bank? Does it get easier to get a mortgage once you want to ask for your second mortgage or third mortgage?
It actually does. It's easier because you're buying properties that make more money and improves your debt service coverage ratio when you're buying these 1% rent to value ratio properties. When you buy something stupid like your house that makes no money, it screws up your debt service coverage ratio. So it makes it harder for you to qualify for a loan. So the more rentals you get, the easier it gets. But here's the problem. When I had 2015, when I had 11 rentals, you start to get a little spoiled. I had maybe $3,000 coming at me every month and a few $100s per property. But I was having an eviction or two every year, some kind of big issue that happened every quarter, which is no problem because the professional property manager takes care of that. They're on the front lines doing that work for me. But I don't know what any family can survive off $3,000 passive cash flow a month. And this is where I started to join different masterminds, get around other accredited investors, higher net worth investors, and I realized they had transitioned to investing in private placements and syndications, which are kind of like country club deals where a pool of investors will pull money together to go buy a better deal, a bigger asset such as an apartment complex. And this is kind of where I transitioned from buying little rental properties to buying larger pools of properties.
And what was your motivation? Is it to buy bigger assets at once, or is it because it was giving you a higher yield?
It was a higher yield, better tax benefits, but I think most importantly, the thing that compelled me to kind of make that jump was, like owning 10 properties isn't that hard to manage, but if you own 30 properties, you quickly go bonkers and it becomes a job in itself, even if you have professional property management. So you kind of transition, when your net worth becomes $500,000 to $1 million net worth, you got to transition to more for scalability in a larger deal.
If tomorrow someone wants to get started to buy their first house, a buy-to-let investment, how would you recommend that person to source his deals? How to get the right flat?
I would recommend going to my website, simplepassivecashflow.com/turnkey. It's kind of a complete guide to buying a rental property. It kind of teaches the analyzer in there that this is a lot of numbers driven. And then you go and assemble a team of property managers and brokers. And then you get a third-party property inspector to inspect the property. So these are the team that you're building to help vet the property to make sure you don't buy a lemon, and to ensure that you're really going to collect the rents that you thought that you were going to collect to be able to cash flow. The first one's always the hardest, right? But I would say kind of start there, educate yourself, listen to my podcast. The first dozen podcasts were all about buying rental properties on your own. Over the years, the topics have kind of changed to more accredited investor, high net worth strategies surrounding tax, life insurance, and syndication investing. But I would say if you're kind of new out there, start with the turnkey content first.
Did you visit yourself your own properties in the early days, or did you trust a broker and a property manager to just give you the deals and tell you, Lane, this is the deal, just buy it?
Yeah, I kind of trusted people in the beginning. I didn't visit my properties. It's kind of
Really?
Yeah, it sounds crazy, right? But a lot of people do this
It
the
does
right
sound
way.
crazy.
Do it. It's just finding the right people through referrals, and then trusting them, and then refining the process in the next go around, right? As you start to learn more and more and more.
So what did you do in the whole process?
Well, what do you mean specifically?
So if you didn't source the property, if you don't manage them, have you outsourced the entire process?
That's the idea, man. That's why it's freaking simple passive cash flow. You try and do as little as possible. You have professionals on your team kind of doing all the specifics. your role here is being the investor. We always say you don't want to be the landlord, you want to be the investor. You're the person you're the project manager. It's like, what does a project manager do? They technically don't do anything, but they're the orchestrator that kind of puts together, finds the deal, finds the professionals, and kind of puts everything together. I would say the biggest part of this is the property manager, because this is the person who's going to operate the property, find the tenant for you, manage the tenant, get all the contracts for you signed, collect the rents, and then they're going to come to you for management decisions. Hey, Sam, should we fix this? Should we not?
Sounds fair. Pretty easy, isn't it?
Yeah. Well, it's not easy. It is kind of simple though, right?
And at which point then do you think people should completely leave their job and become full-time real estate investor if they're successful in their strategy?
Yeah, well, I mean, technically, once your passive income has exceeded your monthly burn rate, you're financially independent, right? You've hit zero gravity, you're weightless. So for a lot of people, that might be $5,000 a month. That might mean like 15 or 20 houses. But everybody's different, right? I think it doesn't take too long to get to that many rental properties and that passive cash flow and then once you get up there, it gets easier, right? You start to get into syndication deals. I mean, why stop at $10,000 a month? 20,000, 50,000, just kind of more and more and more and more and more.
Can you tell us how it works, the syndication deals?
Yeah, so syndications are larger deals put together where passive investors come in and pool together their money. The analogy we like to use a lot is like an airplane. So in the airplane, you have the cockpit where the general partners sit. These general partners source the deal, they manage the property managers. Their role is asset managers. They get the debt in their name, so none of the passive investors have debt in their name. They're on the front lines for legal liability as managing members. And then the passive investors can come back and coach the airplane, pay their investment, put in their investment as passive investors, and sit back and relax and cash checks. And passive investors board multiple planes. They can be in dozens and dozens of deals. And the beauty of this is they diversify their portfolio across many different asset classes, apartments, self-storage facilities, mobile home parks, commercial storefronts. And they can also, not have to do any of the management abilities, right? But the hard thing is like finding these deals, right? These are country club deals. Unless you expand your network, you won't get access to them.
How do you network with other real estate passive investors?
Well, I mean, part of it is like finding the right people, right? Like if you go to most real estate clubs, in my opinion, aren't very good because it just has people who are broke trying to get rich quick. Right? These are the guys flipping houses, wholesaling houses, trying to use all these no money down strategies. As a passive investor, you're trying to find other high net worth passive investors. And it's hard. A lot of these guys, they value their privacy. They don't have time to go to some happy hour thing with a bunch of random investors, right? Because a lot of them have high paid jobs, they have families. Easier said than done, right? I think the important thing is to stay away from a lot of like the time wasters, such as the real estate clubs or like these businesses or these types of free kind of meetup events. But I think what you have to do is be on the lookout for other high net worth investors. And once you find one, build organic relationships, real organic friendships with people, and stay close to them. And they'll find other people too organically.
You know what's striking to me in everything you say? It's also logical and it's so simple. And the reason I'm saying that is I've been in a couple of meetups with some kind of real estate gurus. And although I'm somebody who has been in the financial sector, investment banking, and heard a lot of jargon for like many years, I couldn't get what they were saying. It sounded like plain full bullshit.
Yeah, because it is a bunch of bull. A lot of those kind of real estate gurus, and this is kind of what I do, and I put it all on my website for free, is because I'm upset because there's a lot of people out there trying to sell these expensive programs to
Exactly.
people who can't
That
afford
don't
it,
seem to make any sense.
right? And then what's worse is they work with people who can't afford them in the first place. If you don't have
They
money,
work
I'll
with
tell you
people who
straight up, don't work with me, right? Don't go to my website. If you don't have money, you got to get your finances right, buddy. But if you're responsible with your money, able to save at least $5,000 to $10,000 a year, get on the simplepassivecashflow.com train. Learn what we do, and educate yourself with all the free content that we have.
Yeah, plain simple. The problem is in the real estate investment sector, there were a lot of gurus that kind of gave a very bad image of real estate investment because, as you said, they're just chasing for people who don't have the financial education. They don't know what they're buying. They kind of want to believe in this quick get to rich quick scheme. And whenever you hear get rich quickly, it's most of the time a scam.
Right. And a lot of those meetups are the worst, right? They'll teach you how to call your credit card company during lunch and get an increase so you can buy their program at the end of the day. They'll place people in the audience to run to the back of the room to create a frenzy.
Yeah.
It's just
I mean, it
horrible.
was so obvious. It was so obvious to me that it was a complete scam. But when people don't have the financial education and they kind of sound impressed by all the jargon and the way they explain it, oh, you have to build a system, blah blah blah. Whereas it just doesn't make any sense. Real estate investing is plain simple. Get the money, leverage yourself, buy your first flat, get passive cash flow, buy a second flat, and your balance sheet will grow.
Right. The hard thing is saving the money, and this is why I like real estate, because there's a barrier to entry. If you don't have money, you don't have 10, 20 grand, you can't even start to do this stuff, right? And this is why I like to invest in apartment complexes today. If you can't get 5, 10, $20 million together, you can't buy said apartment complex.
So now let's talk a bit about risk management. You have a huge portfolio in the real estate. How do you diversify yourself?
So we kind of go after a few geographic areas, and one of the things I tell my investors is you don't want to go into any one deal with more than 5 or 10% of your net worth. Right. So this is where the syndication model comes in wonderfully for LP investors, as they're already LP investors. Usually the worst case scenario is they lose their initial investment. They're kind of hedged to the downside in that way. But as LPs, they can diversify over a multitude of different projects to kind of stay under that, that being too heavy in one project, just in case one does go bad.
Got it. So never more than 5 or 10% of your net worth in one single deal.
That's
you do geographic diversification. Do you do also like income stream diversification, commercial real estate versus residential real estate? Do you try to
so I'm in all
types?
commercial real estate. I stay out of residential real estate, primarily because residential real estate is based on emotion. It's not based on numbers. Right now, the supply is very low. I don't know what demand is. Demand could be higher, could be lower, but because the supply is low, prices are high, which is stupid to me. It makes no sense. But this is why I stay in the commercial real estate realm. And also because we do value add real estate. So what we do is when we buy like a 300 unit apartment complex, we'll rehab the units slowly. We put $4,000, $6,000 into every unit. New appliances, new flooring, new paint jobs, some playground equipment for the community. And we'll be able to bump the rents up maybe 10%, 20%. And then that way, that's how we're able to force appreciate the property, because the property's value is based on not comparable sales, but what the net operating income is divided by the cap rate. So it's kind of like those people who own businesses, they know that their EBITDA divided by the multiplier is what their business should be evaluated as. Same thing as an apartment complex or a commercial piece of real estate.
Do you find the pricing in the commercial real estate to be more rational than in residential?
Right. Commercial real estate is based on net operating income, which is essentially your profit divided by the cap rate. Period.
And that's it.
That's it. So if you have control over your net operating income, right? If you can increase your income or decrease your expenses, you improve your net operating income, thus changing the price of your asset. So this is the difference between, people talk about appreciation a lot, but I kind of did break it out between market appreciation, which is just luck, right? Market can go up and down, and then
Or
force
inflation.
appreciation. Force appreciation is taking work in your own hands to increase the net operating income by putting in hard work, adding value to the asset to increase the asset's value.
Mhm. Could you explain in simple terms, how do you do that? How do you increase the operating income?
Yeah, so let's take for example, if I bump the rents up 10% across the board, 10%, normally our rents are, so let's say $70 on $700, or $100 on a 100-unit building times 12 is $120,000 of extra net operating income a year. So if I divide that at a 5 cap, what I've done is increase the value of the property by $2.4 million. It's kind of crazy, right? All I did was bump the rents up 10% on a
But
100
can
unit.
you? Are you a price maker?
What's that?
Are you a price maker? Can you just increase the rent?
Yeah, I mean, if we're improving the product, making the unit nicer, instead of getting rid of the dingy floors, putting that new LVT flooring in, kicking out all the deadbeats that live in the community, making it a nicer area, power washing sides of buildings, new appliances. Yeah, I mean, people pay it all the time, right? Of course, this is where you have to buy the right property in the right area to absorb that price increase. And it doesn't take overnight to do this, but it's something that we've consistently shown that we can do in the right properties to make a small change like that, all while we cash flow.
Okay, so you're buying property where you see a potential to increase the value, then you will improve like the value of the property to increase the rent and then get even more money and more cash
Right,
flows.
right. Ideally, we buy properties that are already on their market rents. So even if we didn't do anything, whenever the next tenant's rent is up for due, we just increase the rents maybe $50. That's called like natural
Mhm.
increase in rents.
But
But
how do you know that?
we
How
know
do you know
that,
if a property is rented underpriced?
well, in apartments, we have a lot better data sources for this. This is why we like apartments. Apartments are very commodities. They're just boxes, essentially. And there's a lot more of them. Whereas single family homes, they're all different, right? Different locations. It's not as streamlined data that we can get with apartments. At the end of the day, we always verify this walking the street, right? We go into competing apartment complexes. We see the level of their product and what they're pricing it at, and their level of occupancy, and we can kind of spot check that within reality. But yeah, we don't buy properties unless we already know that there's already low hanging fruit there, right? But we also want to know that there's additional upside to bump the rents up. We've bought properties before that are renting for $400, $350 a month, and we can bump them up to $700. That's an extreme case that we love all day to do. But to bump rents up 10%, 15, 20% is pretty customary, especially when you're increasing the living condition of the units, right? It's one thing just to bump the rents up $100, but what we're doing is we're kind of drastically doing a big facelift on the units, and tenants are happy to pay that. If not, they leave, and we don't want them, and we get somebody else in there.
So you started with residential real estate. At which point did you switch to commercial?
When I had 11 units, we moved to from residential properties to larger commercial assets, better pricing, better economies of scale.
Okay. Do you ever sell your assets or do you keep them for passive cash flows?
Most times we keep it for passive cash flow, refinance our original equity out, so we're in there for no money, none of our original money, so we can kind of play with house money. In certain occasions, when somebody comes around and offers a stupid price, we'll sell it, right? So it's a robust business plan. We're cash flow guys. as long as the asset is, low headache to manage on behalf of our investors, we'll do that. But, we're flexible, right? If something changes the economy, we can move. This is why I do this type of investing, is because I think it's probably the best risk-adjusted return out there. I mean, think about it. We buy properties that are already stabilized, 90% occupied or more, and we're cash flowing day one. It's like buying an existing business that has a very strong cash flow stream. And we buy it with the ability to fix it up with the money that we have and bump the rents up even further to capture that forced appreciation. And if market appreciation happens, then awesome, right? That's
Cherry
icing
on
on
the
top
cake.
of the cake, right? That's when the prices of the properties pop, and we like to get lucky. But should the economy take a tumble back, right? This is why we invest in this type of stuff. Workforce housing, lower middle class sector. I mean, the population is increasing here in America, and we'll keep continuing the cash flow. Heck, maybe we'll get the rehabs done cheaper, right? Because people are looking for jobs.
Have you ever considered starting your own real estate investment fund? Because it sounds like your returns are beating a lot of the real estate funds.
Yeah, I mean, that's what we do today. We don't operate in a blind pool fund. We operate by individual properties where investors can pick and choose the assets, as opposed to clumping everything in a blind pool. When I'm a passive investor, that's how I like to invest. The problem with the funds a lot of times is, people will just put junk in the fund, right? It's kind of like a hot dog, right? Parts of the cow nobody wants.
Awesome. Lane, where people can hear more about you?
Yeah, they can check out my podcast, Simple Passive Cash Flow, and then check out my website, simplepassivecashflow.com.
Awesome. Thank you very much, Lane. Wishing all the best to you. Cheers.
Cool. Thanks, Sam. Take it easy, man.
Thank you for listening. I hope you found this episode enjoyable, inspiring, and educational. In this era of instant gratification, it is more important than ever to train our delayed gratification muscle. So keep learning, keep improving by 1% every day. You may not see the results right now, but this is a secret of all the successful people I've met. Please help me spread financial education by sharing this podcast with your friends and community. I would love it if you could also leave us a review. It really helps the show. Now, I would like you to forget about all the advertising that is being pushed to us on a daily basis and think about your personal financial goals. What do you really want to achieve with your money? If you have financial objectives, then check out the Nova Money app. Nova is an AI that will show you how to set financial goals and how to achieve them. A plan is only useful if you can follow it. That's why Nova will send you daily motivational messages to give you the strength to ignore the daily temptations of spending money and stay focused on your goals. Like other budgeting apps, Nova connects all your bank accounts in one place to give you the full picture. The difference is that the Nova AI will do all the budgeting and tracking for you. The second difference is that unlike many free personal finance apps, we don't sell users' data. All your data is encrypted and will remain completely private. Make sure that you're investing in your financial education. Make sure that you're building your financial freedom. And I'll speak to you in the next episode.